Hello everyone, thank you and welcome to my channel. Today I'm going to discuss how loans are classified in banks in Kenya in detail. And loans in Kenya, they are classified in four categories. They are what we call normal loans. There is loans under watch. There are loans under substantial or doubtful losses. And those are the four categories which you need to know. In other terms, loans can also be called, maybe if you have ever maybe discussed or if you ever had a loan with a banker, they will tell you your loan is performing or your loan is not performing. So there are those four categories which are deeper, and most of the time our customers don't understand why his or her loan is being discussed as performing or non-performing. And if it's not performing, why do you get a lot of pressure to pay your debts or your obligations on time? So the first category of loans is called normal loans. This is a loan which is fresh. You can say those are loans which have no problems at all. You are paying on time and you have never gotten late at any given time. So those loans are classified as watch. And those loans are half days or categorized in a number of days. So if your loan is performing within the first day to 30 days, and those are the days which you are given to pay your loans, monthly repayments, it means that that loan within the 30th day when it is due, you have paid it or it has been paid. So assuming your loan has not been paid on the 31st day, immediately that loan is classified as under watch. So you are not supposed to surpass at least one day of your loan because it will be categorized differently. So a loan is normal when you are paying it well and it's not on any default. So you are paying on time when you're expected to pay, if it's on 2nd, 5th, 10th, 15th, like and so forth. If you are paying on time, your loan is categorized as normal. So when your loan is under watch, it means that you failed to pay your obligation for a particular of days. That is the days past that first 30th day. So if it starts counting the first day of default when your obligation was due, that loan is categorized as watch. And what happens is that as per the central bank guidelines, those loans the loans which are classified in that manner, they are supposed to be given a particular percentage which must be taken from the profits of the organization to cushion the bank and to cushion the customers in case the bank is running in problems. So that's why you see banks being protected very well, because they are running with our money. They don't get money from government. It's our deposits which are in the bank, and those are the deposits which are used to lend to other people who need the finance. So for them to cushion in case of any problem, that's why these loans are being provided for. You see? So that is the reason, one of the major reasons why the loans must be categorized or must be provided for in case maybe the bank is running into issues. That money which was provided for can be used to pay back to the customers who had their deposits. So that is about watch. The third categorization is called substandard. Substandard, this is where the loan has not been paid from the 60th day or the 61st day to the 90th day. That means you have not paid your loan for 3 months. I think I'm clear on that. So if you have not paid your loan within a maximum of 90 days, which is equivalent to 3 months, your loan is categorized as substandard. And when your loan is as a substandard, the bank should take a provision of that loan or entire loans. If you have, let's say, if the bank has 1,000 or 10,000 customers and their loans have not been paid for at least 60 to 90 days, they are supposed to provide 20% of that. So that's why most of the time you might see a bank pushing very hard to do their collections, because if they don't do that, it's most likely they might provide a lower profit or lower their profits, their annual profits, and it will be a big challenge to the bank to explain what is happening over there. And they have to report to the investors and people who have given them their money in terms of capital, or on what is happening and why are not able to get their dividends on time, or why they are not able to get their dividends with a good return. So banks, once they provide that 20%, assuming a bank had, for example, 500 billion of shillings or whichever denomination you might think of, and provide 20% of it, that's a very huge amount taken off from the profits. And it is assumed that those loans will affect the balance sheet in either way. And even if they are going to be paid the following day, it's upon the law to make sure that those loans are provided for. So that's why it's important for us as individuals who have borrowed in those banks to make sure that they are paid on time, because it will affect the person who has invested in that organization, or it will affect the person who has given deposit to that bank in any particular time. So the last point is called doubtful or loss. So assuming that loan has been on default for the 90 days plus up to 160 180 up to 1 year, those loans are considered as doubtful, or we can say that they are on losses. And in that case, those loans are supposed to be provided 100%. So again, get the figure of whereby the customers have borrowed maybe 500 billion or whichever figure, and they fail to pay for at least 90 days plus. It means that the bank is supposed to provide 100% of that. That means on the profit side, on the income statement, it will be zero profit. On the profit and loss account, when you look at the profit, it will give you a zero. That has a very negative impact to any organization. So those are the four items you're supposed to have to know about provisioning. And there's also another factor which I would maybe like to mention it briefly, and that's why that is about security. Why do banks insist on at least a security to be provided to cushion their loans? Is because if you have a security, it also cushions the bank when it's doing these provisions. Because now, if you have for example, if you have borrowed a facility of 1 million and you have a security which is worth 1 million, it means that when they are doing their provisioning, the four things which I've taught you, the normal, the watch, substandard, and and losses, it means they cannot use the percentages to give the provision, because the loan is covered 100%. So in case of anything, they can go and sell that property or enforce recovery of that property and the money will come back. So it means when they are providing, they cannot do any percentage on your loans. So that's why they insist on those loans to be secured, just to cushion themselves and to cushion the investor, because the person who has invested in those organizations needs a return of his or her investment. So thank you very much and welcome. If again next time for my to my channel, please give me some thumbs up, follow my channel, and I'll be glad if you can also leave some comments there. I'll be able to answer the questions as they come in. You'll be able to get more of what you need to know about loan provisioning. Thank you very much.